Hello, ladies and gentlemen. It's a modern investing. My name is Sasha. I would like to introduce my co-host, Peter Bennett, a veteran of Wall Street, and Nick Poliveda, the founder of our network. So today is Up Day, which usually happens on Wednesday, not 100% as we know. In this market, nothing is 100%, but more likely it would go higher than not. So today is such a day, except the tech stocks. They continue to take beating, except the leaders. The Microsoft, which is almost 7% up today. Apple is doing well. And Nvidia, I think it's getting out of malaise, and but it has a long way to go. So I wouldn't recommend to get any increase in high tech positions except those stocks that I just mentioned. Peter, how is your look on the market? I know you're big on energy as usual.
Oh yeah, of course, energy. The markets. I was looking at these S&P 500 just now. The trust is down 14% year to date, roughly, and it's not surprising given what we've been talking about on the show longer than everybody else. I think almost everybody else. Inflation and energy and those issues. I saw several things. One, I saw today on Fox Business, actually, they said there are 23 large cap stocks that are down more than 50%. And that just is reflection of the rotation that's going on, because people are basically going crazy because we don't know what to do. You have a lot of cash on the sidelines, a lot of cash that could be deployed, but people are nervous now and they're starting to pull money out of the market. So, makes sense, because in the end, it's all about uncertainty. First of all, before I even talk about that, Morgan Stanley just came out this week. They said the markets are about to fall sharply. That's their words. And that the market will enter a bear market. And that's not surprising to me. I mean, we've been saying that for a while too, but they just said it. And that's a big, one of the major brokers. And, that alone could be self-fulfilling, because they have a lot of clients who could pull money out of the market now and saying, oh, my Morgan Stanley broker says I need to, get more defensive. So it's really been a rotation to energy a lot, and then to some of the other defensive sectors. There was an interesting Barron survey of money managers this last week too, and they said that first of all, they asked the money managers a lot of different questions, but one is, what are your clients thinking? And that 64% are neutral, 24% were bearish, and 12% were bullish. So not a lot of bullish sentiment. And if you're bearish, you're nervous, because if you're if you're also neutral, you're pretty nervous, because if the market goes down and you're neutral, you could easily be swayed into, okay, I can't take it anymore, I'm getting out. And interestingly, too, some side notes on it. The best international market was the U.S., which I totally agree with. Number 2 and 3 and 4 were emerging markets, China and Europe. And I've been saying forever to stay away from these. I mean, Japan is very dependent on energy, just like Europe. And now, even today, Russia's saying they were going to cut off Poland, and I think it's Bulgaria, because they're saying that they want to get paid in rubles. But Europe is totally put themselves at the mercy of Russia, which is terrible for them. So this is not good for the markets, in terms of energy crises around the world. And most important about energy, which I've been saying for a year, almost maybe 8 months ago, USAC, one of our holdings, said that the oil companies are underinvesting in capex by 40%. And that was almost a year ago. And I said, wait a minute, that's just to maintain oil and gas where it is. So now Moody's came out last week and said that we need to increase capex on energy by 54%, or there's going to be a major crisis. So and the oil companies are not going to do this, and OPEC's not going to do it. Why? First of all, they may look at their business as terminal. They may be saying, in 20 years, we're not going to be in business. So why are we going to keep over investing? We're going to pull some of the profits out. That's what anybody would do. And also the Biden administration's hostility to oil. They finally released some leases. They released 20% of the leases that were supposed to be that were normally released. And for a while, they wouldn't do any, saying, "Oh, they have 9,000 leases," but they did. That's not how it works. But and then they charge 50% more for that 20% of leases they released. And also they're doing the oil reserve, release. They're just using 1/3 of the U.S. oil reserves, which is to me insane, because now we're going to have 50% in our oil reserves, and at the end of basically at the time of the election, nothing political here, but we're going to release the reserves until the election, just about to the day. Then they're going to have to refill those reserves, and they will need to be refilled. So everybody's concerned about inflation in the Fed, which is right, because now the Fed's talking about 3/4 increases, and I've been saying all along, the quarter, the half, nobody knows, but nobody knows how high they have to go. But I love to quote the two Larrys, Larry Summers and Larry Kudlow, who are on almost opposite sides of the political spectrum, because they both say that rates have to go much, much higher. They're talking about rates like 6% or 2% less than nominal inflation, just to control inflation. So what if the Fed has to keep raising rates and raising rates? Nobody knows this, but if they do, it could really hurt a lot of companies. A lot of companies have maybe 50% of their debt to assets, and nobody really knows. So with all this uncertainty, I actually bought some muni bonds this week, because muni bonds now, if you get a full state muni, because I always look for a full state muni GO. I want my fixed income is like the safest of the safe. I don't want to take any chances with it. I take my chances on the trading side or on even dividend stocks if I would get aggressive with that. But so I put a lot of cash, but not all of it. I still have plenty of cash, but into full state NEOs, yielding about 2.7% yield to worst, 2.9% to maturity, as long as I could go more or less 7 years. I won't even go every state, by the way. I wouldn't touch New York, Illinois, California, Connecticut, even, not a lot, because, I want states that I know, state North Carolina, a state like Ohio, Texas, states that I know the money's going to be safe. So, but if I can get, 2.9%, let's say, that's a lot on a after-tax basis. So, and I don't know and nobody knows if yields are going to go to on the 10-year and the 30-year. Are they going to go to 4, 5, 6, 3? But they have to, even just to cover that. In other words, to be the equivalent of that, rates are going to have to go to 4.5. And my guess is somewhere around there, it'll crush the economy so badly that they won't have to raise it anymore. And maybe before that. And if I knew, maybe I'd put the rest of my money in IRAs and CDs right now at 3%. But nobody knows, and there's a lot, and that is going to make the market very uncertain. So that's where the markets are. It's really about the uncertainty.
Well, I would like to mention when you said that the survey of the money managers and their clients, that most of them are bearish. In fact, it could be bullish for the market, because if they
Mhm.
are bearish, they already done a lot of selling, and maybe planning even more selling. Although if they're bearish, I would think most likely they already done quite a bit of selling, right? If
They
that's the
have.
case, there could be a bullish case for the shares, at least in short term. I'm not saying that we are out of the woods yet. Maybe, probably in Most likely not. I would still the market, even bearish markets. There are sometimes rallies into bear market, and then it continues to go down. So of course, we don't know. We don't have crystal ball. What exactly does it say? However, Nick, what's your approach to the markets and what you're doing these days?
I agree with Morgan Stanley. Markets are going to go bear, and a lot's what's going to happen with the Fed coming up in the next couple of weeks. Sasha,
Yeah.
if they jump the interest rates by 3/4 of a point, you can almost guarantee a bear market. We have all the signs that the economy is going to flush downwards in the next several months. Why? Well, the war in Ukraine has really put a damper on everything that's been going on out there, and the market hasn't reflected that, but it will. And the only question is when. And then if the Fed increases interest rates, it's going to happen again. And I'm not going to say you're going to enter in a 2008 scenario, but like I said, I lived through the 2008 scenario, Sasha. It wasn't the market. The people in the market were not happy. It went down 37%. And as we say in our industry, hey, if the market goes down 50%, all you have to do is make 50% the next year and you're back to even, right? Wrong. You lose 50%, you've got to make like 75 to 100% to get back even. And so what happens is that, well, we lose 50%, we gain 50%, so we're even. That doesn't cut the mustard. So I'm taking the Morgan Stanley approach. By the way, we're broadcasting on the Morgan Stanley network. Thank you very much. I just found that out, and so that's the reason I'm pandering to them. And look what happened to Netflix, one of the stocks we've been following. I haven't invested. The biggest performer in the last 10 years, literally 4,000% return, anticipating 2.5 million additional subscribers. They lost 200,000 subscribers, and their stock just went straight down. And you can see that. I think you're going to see a lot of this take place, because what happens, it goes up and down and down. And then here's the other problem. What's going to bring the market back? Well, flushing the cash into the market, which the government did a couple of years ago, but they're not doing it now. The Build Better program isn't going to happen now. And worse, it just reflected inflation. So I think you're going to go into a bear market this year. Money managers will not move money because of bear market, Sasha, because they get paid for assets under management. So I can tell you, like, if you saw the post, for those who've been on, well, you have, Peter, and so have you, Sasha. David M. Walker, the former Comptroller General of the United States, is on our show every Monday. He just fired Fisher Investments and made a big announcement about it. He goes, "These guys aren't what they say they are. I'm out," And I thought that was pretty cute. But you can see the problem with investment managers, and I work with a lot of them. They're not paid to put money in cash. They're paid to put money in the market. So they're just going to, unfortunately, they're going to ride it down. But as an individual investor, you go, maybe we should be a little bit more hesitant, be very picky on what stocks you go into, and then have a lot of cash on the sideline. So that's my.
Well, future investments are very good in a bull market because, of course, you're right. They're putting all the money at work and they're buying as much stocks as they can. And if the market is bullish, they can do very, very well because they're paid according to performance. Now, on the other hand, if the market is doing poorly as it is doing now, and I'm not aware if they're using any hedging strategy, if they're selling market short, I'm not sure about that. Probably not, most likely, but I could be wrong.
Sasha, everybody's a genius in a bull market.
Right, exactly. But also, but Fisher takes a really nice chunk of percentage.
Yeah,
they take a really nice chunk out of it. And when you look at, you could just buy an index fund, and I haven't looked at their particular performance, but most brokers, if you just buy an index fund, you could outperform them, because they, because of the fees you're paying, basically, they have to outperform the fees, and index funds tend to do reasonably well, especially in bullish markets. So, but the other point somebody just said about, it's like 2008, but what if it's like 1970s? And that's what the market should be concerned of, and that's what I am concerned with. Because if you're talking about, what if you were talking about, well, first of all, what we are talking about is not only 8.5% inflation on the CPI and 11% on the producer price index, CPI is consumer price index, but also by the measures of the pre-80s, we're already at about 14% inflation. If the government changed in the 1980s how they measure it to allow substitutions, quote, but that doesn't work very well in real life. If you want spinach, you don't necessarily buy lettuce. And their whole formula changed. And also a car, if it's a better car, now it's worth more, but people still need cars. And so that real life substitution doesn't work that well. So maybe we're already at 14% inflation. And what if we're looking at 3 years, 5 years, 10 years, or 8 years? I mean, the Fed cannot take that. So the Fed is going to have to raise rates. And nobody knows how long it'll take. And the Fed doesn't know because they didn't even know this was coming. I mean, last year they were so far behind the curve. So how can you say the Fed is doing the right thing now? Maybe they're still way behind the curve. And with that uncertainty, you have to be very defensive and look at the debt to assets of your companies that you're investing in, along with the cash flows, the PEs, and things like that.
Well, I agree that it's very difficult to find any components of the markets that would make stance change to bullish, except one funny thing, the 75 points increase on the Fed. I think that will be bullish for stocks because it will be for sure a relief rally, because 50 points, they will say 50 points is not enough, so they will have to another 50 points very soon. But if they will do 75 points, so people will say, oh, finally, it's gone, it's done. So now there could be a relief rally, in my opinion. But again,
wait. I have to say, though, before you say that, the problem is some people are talking about more than 175, and nobody knows where it's going. But people are every month, the last 5 months, 6 months, whatever, the forecasts are going up. We're going to have a 25. Oh, no, we need a 50 now. Now we need a 75. Oh, we're going to be 2 hikes, 4 hikes, 6 hikes, and nobody knows. But it's a rolling increase. It keeps, and that could put a lot of pressure on the market, because the more when that 3/4 comes, then the next problem will be a month later or 2 months later when the next meeting is. Are they going to do another 3/4? Is this going to be a pattern for a long time? Not to mention, the Fed has said they're going to start selling their assets off. They own a huge amount of assets. I think it's like 1/3 of the mortgages issued now are on the Fed balance sheet, and huge amounts of equities and everything. And that's not, forget about the rate increases. What happens when they start selling into this market? What does that do when they've these huge balance sheets? So by selling off, that could do more damage than the increases.
I've noticed that the high yield dividend stocks are still doing quite well. I mean, there should be some market scare if overall market is getting so weak and there's so great chance of rate hikes and so on, which definitely is very, very negative for the market. So it should be negative for high yield dividend stocks, at least at some point. But so far they're resisting all that. They're doing quite well. And I don't know really what to read into it. It's just that more and more, you see, there's obviously buying. If it would be buying, they wouldn't go higher almost daily. Look at the day like today, they're all going, but today is a positive day, so maybe it's not indicative. But even some other down days when all the tech stocks are taking huge beating and they're going down 5% a day, sometimes some stocks 10% a day, these stocks are gaining and gaining and gaining, and they're already not cheap, as we know. However, speaking about mortgages and other stuff, we have with us Mariusz Konieczny. Please address this issue with the stock which we followed lately. The name of the stock is Voxture and Analytics. So what's your opinion, Mariusz? Tell us more about this company. We still don't quite understand everything, all details, because they do have substantial cash flow, even as we speak, plus very good prospects in the near future.
Thanks for having me again. So I think it's interesting to listen to your guys' conversation about the economy. and interest rates and what the Fed is doing, with certain companies, like for example, like when you have companies that are very mature, stable, um, then those changes in the economy have more impact on them. But when you are talking with about companies like Voxter, which is gaining clients at such a faster rate than anything else that's happening in the economy, they are a little bit more insulated uh, from those turbulent times. And so with Voxter is a company that is a technology company on the real estate side, and they have different divisions. They have the appraisal division, uh, tax assessment division, foreclosure division, and now title division. So on the tax assessment side, they help governmental agencies levy taxes, properly calculate taxes. So that business, I mean, doesn't matter what really happens to the economy, they're always going to want us to pay taxes, real estate taxes. So that business is very stable. On the appraisal side, that's where it starts to come in, because they have technology that makes appraisers faster, because the real estate industry is facing bottlenecks. Appraisal is the bottleneck of the real estate transaction. It takes forever. There's not enough appraisers, and most of the appraisers are, the average age is 62 years old, and we're not replacing them. People don't go into appraising from college. Most of the appraisers are white. So that's a big problem. And so Voxter is solving the problem by making appraisers faster. Then they also have the division, the foreclosure division, that help banks process foreclosures. And probably this environment couldn't be better for foreclosures, because we just finished the foreclosure moratorium. Interest rates are going up. There's going to be a lot more foreclosures now than they have been over the last 3 years. So they're going to benefit from that tremendously. And then, but the biggest one, what they have is what just happened on April 6th, which Fannie Mae passed a new law allowing attorney opinion letter to be used as an alternative to title insurance. And it is a tectonic shift in the real estate space. Nothing in title changed in 75 years. And Voxter has a patent on attorney opinion letter process. And what I mean by process is Fannie Mae had to pass it because all the loans that are originated by someone, and then they are sold to the secondary market. And so all the mortgages have to check all the boxes, which are Fannie Mae and Freddie Mac guidelines. So unless Fannie Mae approves a particular product, nobody's going to use it. So Fannie Mae approved attorney opinion letter on April 6th. And so what Voxter is doing is they're using attorney opinion letter with the process, which attaches the attorney opinion letter to the mortgage, so that opinion letter travels through the mortgage throughout the life of the mortgage. So when the mortgage gets sold to a secondary market, that letter or that opinion stays with the loan. And that's what makes Voxter different, because any lawyer can write an attorney opinion letter. There's nothing special about attorney opinion letter, but what's special is the process. And the process, that's what they have patented, and they are the only game in town. And so the product is getting rolled out like as we speak. There's banks lined up that want to do it. They're going to first start doing it in 4 states, and then they're going to roll it out in all the states. And literally any sort of adoption or market share, stealing market share from the title insurance, it has tremendous impact on something like Voxter. That's why the stock, even though it's sold off a little bit, it's holding up, and it's almost at an all-time high because of this tectonic news.
So, Marius, do you think that another company could go get around that patent somehow? In other words, the trick, I mean, this would save the consumers a lot of money, obviously, on the first mortgage and then down the road. And it would be great for the banks too. I mean, to save the consumers money, and it'll put pressure on them to obviously have it. But do you think that patent locks them up? Is there some way somebody could duplicate the process by getting around the patent to attach it to the mortgage, or so that it would travel with the mortgage, the title search? Or rather, do you think that they've got it locked up and that's sort of an exclusive power of theirs?
So right now, as of now, they are the only game in town, and they know. And the title companies were kind of caught by surprise. They didn't know it was coming. So now there's a little bit of panic in the title business that attorney opinion letter is going to take them out of business. So Voxter knows that probably within 2 years somebody else can develop something, and they might have competitor, down the road. So that's why, in addition to offering the attorney opinion letter through Voxter's title company, they will white label the technology to title companies so that they can have the technology from day one, and then discourage them from developing their own technology.
Well, so they're like a first mover in the business. That could be a huge advantage. Once a bank or title company locks in that process, they'll get comfortable with it. So you're right.
They're kind of like a toll bridge in a way,
right.
And also, you see, people always ask this. Well, what's so special about Voxter? Why can't the competitors do it? What people miss is that Voxter is the one that created this product. Voxter is the one that went to Fannie Mae and said, "Hey, we have a solution." So the Fannie Mae has been working with Voxter on this for the past 3 years, and so not only this, Fannie Mae wants to have like a one portal that everybody goes through the portal, and guess who is building that portal?
Voxter.
Yeah. So even if competitors I have the product, everything is going to go through that portal, and Voxter is going to get, like a toll booth. And it's so the whole system is so ingrained in the operations of everybody else that once it's in place, it's probably going to be in place for the next 75 years, because those things don't change very often. Once they change, they stay, because they impact the operations of the banks.
I took one.
Yeah, okay, go ahead, Peter.
Oh, I was just gonna say I took a 1/10%, very small, because I view it as speculative, and I'm very risk averse in a lot of ways, even though I take chances. But I only take chances when I don't see the risk. I took 0.1% in my IRA, but now I'm thinking maybe a little more, because you're right. I see the growth potential, and the numbers on the stock is the revenue's been growing quickly, and now we have this Fannie Mae change in procedure, which is exactly what they wanted, and they are the first mover, so they could be a dominant company for a long time in that market.
And what's interesting? I was on a podcast, real estate podcast yesterday, and I used the term that Peter Lynch used, that we all have advantages in our industries that we could use and have an advantage over Wall Street. So if, let's say, you're a doctor or mechanic or car dealer, you know something that might be happening within your industry, a big change happening, and you're the first one that knows about it, you could take advantage of it. But most people don't. Most people wait for Wall Street to tell them that something is happening. And so I was on the real estate podcast, and I said to the guy, I asked him, "What state are you in?" And he said, "Texas." And I said, "Did you know that attorney opinion letter is getting rolled out in Texas starting in about a week? Did you know that Fannie Mae changed the rules on title insurance?" He had no idea. And after I told him the story and how people in their own industry miss the opportunities, immediately he was like, "Oh my God, this is a complete game changer." And I said, "Well, that's why I'm on your podcast telling you this."
It is. It could be a complete game changer. It's really interesting. It could be very undervalued. As I said, it's a speculative stock on one side, but on the other side, it maybe the expected value could be very large. I like it more and more every time I hear about it.
To assess how this stock is really speculative, there are 3 other divisions which you just talked about it a few minutes ago. I would like to know more or less what are the cash flow generations by these 3 divisions as we speak.
So, I mean, the stock is speculative on paper. There's no question. When you look at the financials, and financials are always backward looking. When you look at the financials, you're like, oh my goodness, what is he talking about? And it's because of how the company was put together through acquisitions. And so so in terms of the cash flow generation, let's start with the foreclosure business. The foreclosure business was generating about $100 million of revenue, $120 million of revenue before COVID. And so they help bank process foreclosures. And so there was 120 million of revenue, and I think it was generating EBITDA of about 20 million. And then COVID came, and then they put moratorium on foreclosures. So that business went to zero for about 2 years. And now everything's coming back. The moratorium is gone, foreclosures are increasing, interest rates are going up, and now they have probably double number of clients. So could I see that foreclosure business return to 100 million revenue? Sure, but it could return to 200 million because of double the clients. So that business could generate bottom line of between 20 to 40 million dollars. Let's just say 30. So you put a reasonable multiple on 30 million, let's say 20. That alone is worth 600 million dollars. And the market cap of Voxter today is about 600 million. So that business alone covers the price tag of the company. Now let's talk about the appraisal business. I mean, that business could probably generate another 200 million of revenues in the future. But we don't need it to generate that much because the foreclosure division is already covering the price tag of the company. And the biggest money that's going to be generated is going to be the attorney opinion letter, and that alone, if I say, I would say by December, they could be generating bottom line EBITDA of about $100 million. Bottom line by December, run rate.
What's the date for next financial report of the company?
May, they're going to report the fourth quarter, and then they're going to report the first quarter at the end of the May. And I think by June or July, they're going to be trading on NASDAQ.
On main board NASDAQ, right?
Well, right now they're trading. Right now they're trading on Toronto Stock Exchange Venture.
Yes.
And they're going to have a dual listing. They're going to uplist from the Toronto Stock Exchange Venture to Toronto Stock Exchange main board, and then they're going to have a dual listing in NASDAQ.
Toronto Stock Exchange Venture board is a good listing because it makes it reporting issuer, and it provides financial statements or so on. Unlike some pink sheets and some other stuff on NASDAQ, which some companies don't even report, or report only when they want to report, or so on. So,
but they have OTC, which is over the market. They have different divisions, different brackets of categories. So if a company reports and has audited financial statements, then they get a certain category. If they report a little bit less, they're in the middle. And if they don't report anything, they're like quiet or pink sheet. Then it makes it more risky. You have to definitely do more research or more work if you want to get involved in companies like that.
Yeah,
as we're running towards the end of the show, we try to keep it to around 30 minutes, as everybody knows. It's always hard because we have so much to say. I just want to get into the dividend stocks. As always, we always finish with that. I promised not to stay with energy, although last week I talked about CEQP, Crestwood Energy, which I raised to 2% of my allocation because it's like MPLX, which I had to lower to 20% because I just couldn't take it being 30% of my portfolio. But it's very similar, so I like that one. It's another MLP. But the stock of the week is Corning, GLW. Very interesting company. First of all, they have 5 segments: display technologies, optical, communications, and special materials, and environmental technologies. These could all be growth businesses. But it's got a 3% dividend, which in this market is pretty decent. The price to cash flow is 11 times. So it's got basically a cash flow yield of 9 times. And according to TD Ameritrade, 5-year annual growth, revenues 8%, dividend growing 12%. According to E-Trade, their debt to assets is only 0.23. So this is the kind of dividend stock I like. It's low debt, nice growth pattern. I put 0.5% in there. Who knows where it'll be? But here's the other thing about it that I've read the articles about that are very interesting. That a lot of people believe they'll do very well because there's a lot of U.S. federal and international efforts to expand internet access. And time somebody buys a computer, they need to have a glass on their computer, which is one of their main products. And so they're an interesting tech company, and with a 3% dividend. And it's been doing well this week, even against the market. So I like GLW Corning a lot, and that's my pick of the week.
Yes, excellent. I like this company. Haven't invested in this for quite a long time. I'd say probably 4, if not 5 years. But I would definitely look at it now. And I'd like to say thank you very much to all participants of today's program. And Mariusz, special thanks to you to exploring this opportunity, which looks like a really viable alternative in this today's very tough market. And we'll see you all next week. Have a good and prosperous week of trading. Thank you very much, everybody. Bye-bye.
Yeah.